Hello and welcome. My name's Ed Tricker. I'm the CIO of Quant Strategies here at Graham. And I'm pleased today to be joined by four people who, between them, are integral to everything we do at the systematic business here. They cover data, research, implementation, and operations. Guys, if briefly you could introduce yourselves.
My name is Chuck Rogers. I'm the Director of Operations and Execution here at Graham.
My name is Tom Feng. I'm a Director of Quantitative Research.
Andrei Proskuryakov, Director of Systematic Equities.
Alex Martins, Managing Director of Data Science.
That's great, thank you. So when this panel was first proposed and we were trying to come up with content, it does present some difficulties for a systematic business like ours. What we do day to day is very technical. I can't really ask these guys to wheel out a whiteboard and derive a complex series of mathematical equations. I can't ask them to review a couple of hundred lines of code. So instead, I thought we'd focus on some of the philosophy that we have behind our investment strategies and the ideas we're working on right now and our views on the future as well. So we have an admittedly ambitious agenda. I hope we get through it all in time. I want to reflect on the last couple of years. I want to talk a little bit about the present research and the goals that we have, and then close out by looking ahead to the future opportunity set as well. So without further ado, the last couple of years have been, should we say, challenging for investors. There have been many sources of volatility. We've seen the COVID pandemic, we've seen war, we've seen political uncertainty. And these effects have been felt by all in many different ways. Equities have underperformed. Fixed income hasn't behaved perhaps as it once did or as people would like. Commodities have had extreme moves either up or down. And as market participants, we are not immune from these challenges. While performance has been good, it doesn't mean that everything has worked entirely as we'd expect. And I thought that could be an interesting place to start. And maybe, Tom, I'll ask you, so what hasn't quite gone according to plan, if you will?
Yes, Ed, we've certainly faced multiple challenges. Let me start with trend following. It's a trading style that many investors are familiar with. In early 2020, we've seen that you really needed a very fast trend following model to be successful. Whereas if you looked at many other time periods, in general, you prefer to be going slow and steady. And no single speed could have worked during both type of market situations. So what we see here is that a pretty well understood trading style, but now it takes higher level of sophistication in order to generate consistent returns. So that's certainly a challenge. Coming back in general to our global macro quantitative strategies, we use a wide variety of data. There's price data, interest rates, sentiment, and these global macro economic indicators. Those include estimates for growth, inflation, employment, and so on. Now, during a normal market environment, we expect prices to react to the data. But during the early part of the pandemic, the reverse happened. Basically, the markets were anticipating the effect of the pandemic on the economic productivity and outcome before the data caught up with reality. So that caused some of the global macro fundamental strategies that we had to underperform. Another issue we faced was that when the data finally did catch up with reality, you got a lot of outsized prints. For example, you look at initial jobless claims. They went from the range of 100,000 to over 6 million over the course of 1 week. And if you're not careful and you just simply fed those data into a quantitative model, you would typically get an outsized signal that would be meaningless because the model would be effectively extrapolating to the data that they've never seen before. So our research team worked very hard on these. So first, we had to make sure that our models would be handling these what we call outlier data in a graceful manner. And second, we want to make sure that when the market conditions did return to normal, that our models were poised to deliver their expected performance again. And that they did. So we've seen that since this year, for example, market prices are indeed responding to inflation data. And when we look at our macro fundamental models, they are performing as they were initially designed. So this shows us that there are virtues for continuing research, but also virtues for sticking with established strategies and not overreact to short-term performance fluctuations in any knee-jerk manner.
That's great, thank you. And Andrew, same question for you.
Yes, interesting few years, of course. Start of the pandemic, a very challenging time in single name equity space, a lot of disruption, a lot of dislocation. And of course, volatility shock of 2020 March. Not only returns were tested, but as Tom alluded to, models were tested on their inputs. More recent events, war in Ukraine, reminded us that market access and improved cost of that access, something we got pretty used to, is not a given. And complete disruption of access to Russian equity markets is a strong reminder that microstructure disruption is a real risk, and it needs to be accounted for and planned for in strategy design. One thing worth mentioning also is we observe continuous commodification of common style factors. Right, over the last decade, if we look at the graph, we can see a very unattractive picture. Right, on one hand, it's ever diminishing returns, but also increases in volatility and especially recently dramatic drawdowns. So these simple risk premium products, risk is still there and and increasing, but premium part is not so much, right? So the certainly this is a challenge in that segment of systematic equities and for investors in those types of products. Another important reality and also a challenge is continuous rise of passive investment and ETFs. ETFs and related products certainly add another dimension to equity space, but this rise alters liquidity in the market and it alters flow dynamics as well. One can argue that passive takes a portion of liquidity out of single name equity space, and this is a challenge to be dealt with. But importantly, shift to passive also changes the whole ecosystem and the balance in that ecosystem in equity markets. And of course, we observe return of volatility to more elevated levels in equity markets. It presents its own challenges for strategies, but overall elevated volatility, we think it is a healthier environment that presents opportunities that are quite rich for sophisticated investors.
Great, thank you. So I guess we observed this theme of uncertainty. And I think there were many market behaviors, many relationships that probably pre-pandemic were assumed by many or most to be immutable. But here we are and they're changing or they're starting to change. And one area where we see this manifest very clearly is in market liquidity. Chuck, this is very much your domain. Can you kind of introduce that topic?
Sure. We often see headlines in the newspaper with concerns about market liquidity. Market liquidity means different things in different markets. Here at Graham, we trade listed futures. So it's a diverse group of stock, bonds, commodities, foreign exchange futures. And when we look at those markets, there's two broad things that impact them in 2022. One, the war in Ukraine, and affected obviously liquidity in the financial markets, the stocks and bond futures we trade. It also affected commodities. We see stories about energy crisis in Europe, and there's a number of concerns around food supplies. So the impact from the war has been rather broad-based, and it's been lingered probably longer than people thought. The second one would be, the inflation story and Fed's policy response to that. So, probably best to visualize this. We've got a couple charts here that talk about some of these dynamics. This first one is it shows available order book size. So this shows the amount that was posted on the exchange order book for the last 2 years, right? And you can think of it this way: to the extent that your order size is constant, so the amount over the last 2 years you've needed to deal in the market, if that's constant and you're seeing available order size falling, it's getting more challenging to do an execution. There's the potential that your trade may have more impact on the current market price. This first chart here is S&P 500 E-mini futures. It's one of the most liquid futures contracts in the entire world, traded by investors everywhere. What we see here is that the amount that's available in 2022's, start of the war, it fell to maybe 15% of what it had been for most of 2021. It's been slow to recover, right? We're probably back towards around 50% of the available order book size we saw for most of 2020 and 2021. Moving on to the next chart, we've got the benchmark oil contract here. This is the NYMEX WTI crude oil contract, and it's much more clear here. You can just see, in particular, the impact. There was 300 or 400 contracts at any point for most of the last 2 years, and fell to less than 25 or 30 start of the Ukraine war, and it's been just a very slow grind to improve. And the last chart here is U.S. 10-year futures. Again, this year we're lucky to see 50% of the levels we saw for most of 2021. So, liquidity's changed, and it's not just been niche markets, right? It's been, some of the contracts that are the most liquid, the most traded by investors everywhere, which I think probably surprises some people.
Great. So look, investors see data like this. They read articles that maybe paint a pretty grim picture of market liquidity, and then they come to us with concerns. Of all the questions that I've been asked of late, questions around liquidity are pretty high on the list. I guess a follow-up question for you, Chuck, is, are these concerns valid, for want of a better word? Is liquidity negatively impacting our ability to do our business, or have we been able to do things and to make changes to mitigate some of the conditions that you just described?
Sure. I mean, obviously the charts show liquidity's changed. To answer your question though, no, it hasn't impacted us, and we've managed just fine. There's a couple reasons for this, right? Number one, our strategies have relatively low turnover. We're trying to target alpha over weeks and months, not over minutes or hours. We never buy now and try to sell 20 minutes later. We know the best way to reduce our transaction costs is to avoid trading. That's just part of the strategy design. Second one is, we've always had a healthy respect for market liquidity. Just because you can trade something doesn't mean you should, and we know that bid-ask spread and the cost associated with that is real. So we've always been very hesitant to move down the liquidity spectrum, and that's insulated us this year from a number of cost challenges. And probably the most important one is, we explicitly account for cost in our portfolio construction process, right? So we can measure the cost of every trade. It's fed back to the models. And there's a trade-off that happens in the portfolio construction process. It says, what's the benefit I get from doing this trade, from altering the portfolio, against what's the cost, what's it going to cost me to get this trade done in the real market? So it's an important control we have on cost. But if I'm being honest, it's one thing to say we control for costs. It's another thing to actually get it right. And it's been a big challenge the last few years, trying to better really understand what drives costs and what our costs are. And we spent a lot of time with Tom Feng on this topic, designing experiments to better understand it. So Tom, maybe I'll pass it over to you, and you can talk about the challenges of building a model that reflects the costs of trading in the real world.
Yes, Chuck. As you pointed out, the best way to control costs is try not to incur them. So we try to implement an accurate cost model into our portfolio optimizer. And after reviewing this new cost and liquidity data with Chuck's team, it became evident to us that we needed to improve upon a simplistic constant cost model to implement a nonlinear one. So that means that we recognize that the bigger the size of your trades, the more you are going to push the prices with your own trades, and then incur higher costs as a result. Doing this modeling is actually very difficult. One reason is that we don't trade every market every day. So we have a very limited data sample of all the transactions that we have taken. The second reason is that it's harder to anticipate cost before the trading day happens than to explain it ex post, after you've seen the day's volume and all the price actions. To do this research, the quantitative research team worked closely with other departments, for example, operations, smart execution team, and data infrastructure. And we were able to specify the new functional form for a more accurate cost model. The result is that we are now able to control the cost better on a quote unquote average trading day. So that means we can consistently achieve better savings. And with that in mind, we can actually then make the portfolio more dynamic as it needs to be on a conditional basis. So we can better balance the cost on one side versus the need for the portfolio to trade based on, for example, strong alpha signals or changing risk measures. Having done this, now we're in a better position to capture these dynamic alpha opportunities but also try to avoid building up concentrated risk exposure.
That's great. Thanks, guys. Because as I hear Tom and Chuck talk about this, to me, it's a fine example of the importance that culture can play as part of a team. In the systematic group here at Graham, we pride ourselves on fostering an environment where people are encouraged to interrogate, they should ask questions. They're then encouraged to collaborate with their peers and to seek the assistance of those that have sort of skills that they perhaps don't. And ultimately, we find these two things are vital because they help us to innovate. So in this example, Chuck and his team, through a combination of diligence and domain knowledge, they were able to identify an emerging problem. They were then able to articulate that, to work with Tom and his team, and ultimately develop this sophisticated mathematical solution to what turned out to be a surprisingly non-trivial and nuanced problem. And this type of collaboration it's absolutely vital to what we do. You know, our job frankly, it's very, very difficult. The more brains you have working on these difficult problems, you get a diversity of approach, you get a diversity of solution, and this is all for the better. We know that we must continue to innovate. We've got to be creative. We've got to improve all aspects of our systematic process. So with that in mind, let's talk a little bit about what we're working on right now. Now, I always caveat this, and research topics that we're excited about today, we may be less excited about 6 months from now. Again, this job is difficult, and not everything that we're working on ultimately is successful enough to graduate into a client portfolio. But so with that in mind, Andrew, you know, a goal that you and I set for you and the team was to increase the breadth of the systematic equities portfolios. Can you explain to the audience sort of why that's important and what you're doing to try and accomplish it?
Sure. Well, when we think about delivering true value to investors, we think about two main components there, edge and capacity. And this notion of breadth is very fundamental to both edge and capacity, to growth in both of those dimensions. And the way we think about it is we think about breadth of the universe, number of instruments in our universe that directly helps with risk-adjusted characteristics of the strategies. We also think about breadth and diversity in information sources that we bring. And that improves edge, but also improves kind of resiliency of the strategy as well. And we think about diversity in the types of strategies that we deploy and build. And this, again, makes overall portfolio more resilient and more adaptable. So the team is working on a variety of very exciting projects, all related to this notion of breadth. Right. So first of all, we focus on regions outside of US, including emerging markets. And we are not only expanding the addressable universe there, but importantly, we bring higher edge markets into our strategies. It's a lot of work. It's very non-trivial. It's a lot of details to get right or wrong, right? But because of how we do things, because we can deploy process, we think that we can bring a lot of the aspects into more deterministic space, so to speak, and kind of increase probability of success there. We see it as a very attractive area to add alpha for our investors. Then we also focus on niche signals, and they are niche not only in terms of kind of how narrow they are in terms of universe, but also in pinpointing narrow effects. There are a few examples that I can talk about, and one is labor data. So we can look at growth in headcount, kind of ex post things, termination filings, etc. But also more narrowly, we can focus on headcount by function, for example, recruiter or HR job postings, right? They reflect management sentiment in how aggressive they're going to be going forward about hiring. We can look at growth in sales force is a very direct expression of management sentiment towards where they think their company is going in terms of future growth. All of these are predictive. There are plenty of challenges with sourcing, unifying, interpreting this data, but it's very interesting reflection of economic reality and dynamics for companies, industries, and even sectors. right? Another niche category is sourcing business process data as it becomes digitized and available. It comes not from your traditional data providers. An example would be here custom shipping data that is sourced from the provider that has legacy relationship on the ground in ports, difficult to replicate. And now they realize that there is value in that data to be unlocked, and they digitize that data and start to sell it and make available for people like us. The way we see it is value of unique data is being unlocked, and we see ourselves as very well positioned to participate and extract alpha from that for our investors. Third thing, I keep coming back to ETFs. It's a large and growing piece of current equity markets ecosystem, right? And if we look at number of US listed equity ETFs, we see that the number more than doubled over the last 8 years or so. It's a dramatic rise. ETF universe, the number of US listed equity ETFs becomes comparable to single name equities. But if we look at AUM of US listed equity ETFs, we see even more dramatic picture of 5-fold rise, enormous liquidity bucket, right? The challenges here are obvious. Liquidity effects of ETFs growth on single name equity space is very significant. Portion of liquidity is essentially taken away, right? But there is an opportunity side to it as well. This segment of equity ETFs is large and liquid, right? It's well integrated with the rest of the equities market. There are structural and informational linkages that we can exploit and focus on, and there is very rich data as well. Because of this, we see ETFs as a very interesting and attractive opportunity for our style of investors. So I would just wrap it up at those three.
Fantastic, thank you. Look, Tom, a similar question for you. I know two sort of main research goals that we had. Firstly, we wanted to make the portfolio as adaptable as possible. And then second, sort of similar to what Andrew was saying, we want to incorporate a wide range of rich, informative, and predictive data sets into the process. Can you kind of elaborate on those?
Sure. So we are not in a world where we can just run a trend following strategy with a 1-year look back, or just put together a suite of generic risk premium factors and expect the portfolio to deliver strong returns in all kinds of market environments. In fact, it's impossible to know for sure what type of environment will be coming our way, right? So it is very important to make the strategies themselves adaptive, so that they can work in changing market conditions. So let me again start with trend following. We know that no single speed works at all times. The situation is a little bit like driving on a multi-lane highway, and you sometimes wish that you were in a different lane. So at Graham, we developed these what we call adaptive trend following models. They can adjust dynamically the speed at which they detect trends. So at the short end, you have a couple of weeks, and on the long end, you can go well over a year. And they do this adjustment by employing various machine learning techniques. If you're going fast, you can hope to trade short-term trends in even range-bound market conditions. Whereas if you go slow, you can latch onto these big price moves without getting stopped out by some temporary price reversal. And then coming to the other trading styles, for example, macro fundamental models. We make those also more adaptive by identifying the market regime that we are in. Some examples would be low inflation, steady growth. That's one kind of regime, that one we've had for many years. And there's current worries about possibly a stagflation type of regime. So we dynamically try to identify the regime we are currently in. And then the model recognizes that in different regimes, the markets respond to different sets of drivers. And the models will try to identify which drivers are most relevant and how they interact with each other in order to generate dynamic forecasts. And furthermore, we are always considering the question of, are we missing factors? We already processed more than 1,000 different macro data series, but these are all numeric. And then we have news text, which are non-numeric data, and they can give us information pertaining to, for example, geopolitical situations or anticipating what the central bank policies might be coming our way. We have built a set of new sentiment indicators for commodities based on in-house developed natural language processing capabilities. As an example, since the war in Ukraine, this set of indicators has been able to detect anticipated shocks in the global supply chain for energies and agricultural markets. And it did so faster than the government published production and inventory reports could. So based on this success, we are now expanding the research to cover all financial assets as well. And inside this process, we anticipate that we will be using a lot more data than we previously had. So maybe Alex, I'll turn over to you and you can explain how your team plans to address our data needs.
Of course. Well, as you've heard from Tom, Chuck, and Andre, and ultimately, collaboration is at the core of the investment process here at Graham. And the main way we collaborate is through exchanging data and insights. And this has forced the data science boundaries to become increasingly blurred. And this is a great thing. This is a very good thing. Because on the one hand, we've been forced to become increasingly sophisticated in our quantitative skills in order to support and interact with our quantitative and portfolio manager counterparts in research. And for example, we're talking about natural language processing, understanding the techniques and the models that are going to be applied and how these feed back into every link of the data value chain has become increasingly important and not something that should be done in isolation. On the other hand, there's also been an increased requirement for sophistication on the engineering and hard skills side, because we need to incorporate best practices that need to remain inside of the data science domain and improve these engineering practices to support a faster innovation cycle. You've heard from Ed how not everything is going to go to fruition, and we have to do this in a faster way. With respect, to data as in the context of in investment research and alpha, the data has become increasingly diverse. We've moved beyond market data and fundamental data into different varieties of alternative data, all of which have varying domains, varying semantic models, and varying frequencies. But they all we have to figure out how they interact with the entities that we look to invest in. And that is one of the key challenges that we face from the data science perspective. Finally, I'd be remiss not to mention the recent developments in AI and machine learning paired with the proliferation of distributed computing and the impact that has had on the entire data pipeline. It has allowed us to enrich and augment the data in ways that were never before possible and have led to a source of craftsmanship in the development of the data pipeline that we've never seen before.
Great, thank you. So I guess as we discussed at the beginning, many pre-existing relationships are changing. And that does present some challenges for systematic businesses like ours. What we do is ultimately predicated on an extensive analysis of historical data. Therefore, we need to be very careful that when we build models and they make predictions, that they don't just predict the past extremely well, that's easy, but rather they've got to continue to predict into an uncertain future. This is why we build models that, as Andrew described, are broad and diverse. Therefore, they're not dependent on one single thing working in order to be successful. It's why we build models, as Tom described, that are adaptable and that can adjust. We recognize that a specific parameterization that was best for the last 10 years may not be for the next 5. Instead, something that can adjust and that can learn as new information presents itself should do better over time. We feel that these approaches are, frankly, they're pragmatic, but we think that they're important and they put us in a strong position to continue to deliver robust returns over time. I want to switch gears for a moment. I think one aspect of our business that people perhaps don't always see, and that, dare I say it, is maybe a little underappreciated, is our process. You've heard how we're consuming more and more data. We have increased the range of capabilities that we have. Our strategies are more complicated today than at any point in the past. Given all of that, how do we continue to ensure that it runs like clockwork? I guess, Chuck and Alex, this is very much your world. You guys do a great job. Can you kind of talk about that for a few minutes?
Sure. So, in order for systematic strategies to be successful, they got to be scalable. We run a pretty complicated business here at Graham. Every day we're ingesting thousands of data streams. Our models consume them and create portfolios on behalf of our hedge fund clients, mutual fund, UCITS, and we manage accounts for 35 different types of client accounts. It's complicated. After we've built the portfolios, we actually have to go out and trade them. Trade on a 24-hour basis, 5 days a week on global exchanges. So how do we do it? It's twofold. One, we've built a machine that automates the data collection, signal generation, trade creation, trade execution, compliance. All of that should work with in a perfect world, three or four pushes of a button. But behind that, it's the people. We think of them as the skilled operators. Technology, the things we've built, they're not magic wands. They're built by people that are here, and the world changes. We've seen liquidity change. We've seen new investment challenges pop up all the time, and so we constantly need to be innovating and adjusting the tools we've built to manage our business. As it relates to data, I'll pass it back over to Alex, who manages that team. But I'll just say this: we've been doing this for a long time. It's 25 years, and we've seen a lot of things, and we've benefited from it. We've really focused on learning and getting better over time. So for data, that means we've added many, many, many different checks to ensure the data is right. But we live by a trust but verify model here, right? So we want to build as many checks as we can, but we keep people as close to the data as we can too. So we're staffed 24 hours a day, and as data is coming in, people are looking at it. People are on top of it. People are adjusting the checks we have to deal with it. So trust but verify has been something that is really important to our success here at Graham. I'll pass it over to Alex, and he can talk more about the particulars about how he thinks about the philosophies behind managing the data team.
Thanks, Chuck. Yeah, definitely one along the same lines of what you were saying. There's key principles that we have here. One of them being, quality starts at the source, and this expands the data science focus just from beyond merely acquiring data from reputable providers to actually looking into the data, analyzing it, and passing it on to skilled personnel that's going to decide whether the quality is up to our standards. And then we do that even before we consider subscribing to anything or even publishing something for production. Right? The focus naturally, in our world is on large volumes of data being a systematic shop, and that being alternative data, market data, and that ecosystem is naturally segmented into providers of different quality. We only select the ones that are that prove to be the best. Now, beyond using these data providers of the highest reputation, a lot of the work goes into the like I said before, into the craftsmanship of the data pipeline to make sure that nothing goes through that could cause a potential disruption to any of the systems and processes and models that our colleagues here at Graham use. On a different note, one of the key things that we look at is maintaining the scale and doing this in a way, investing into a technology stack that allows us to do this within the time constraints that the models have to react and the data with which the data needs to flow in. And on a final note, while both domain expertise and qualitative skills, all the things I mentioned before, play a huge role, we do spend a lot of time in process. And one of the key things that I want to highlight is a lot of the work goes into deploying models happens before, right? We have cross-team evaluations that look at the entire process a model or strategy is going to go through before any change is made or before a model is even put into production. And with that, I'll pass it back to you, Chuck.
That's a good point. At Graham here, it's all about process and procedure, right? We talked about we built a machine that's automated many of the functions. We've got a handbook for it. I'll give you a quick example. A researcher develops a new investment model, right? Before that's even considered for client capital, it's got to pass through a whole number of predefined steps, right? So one, it's reviewed by, we got a quality assurance committee here at Graham that steps through the code, right? The model is just a series of lines of code, steps through that code to make sure it complies with all the standards we've set out in advance. Then that model's tested in our user test environment, right? It's a clone of our production world where we can test, make sure all the pipes are working like we'd expect. Then Graham makes a proprietary capital investment, a small size, and trades that model in the real world, right? So trust but verify. We think we built a model that works. Let's go out in the real world and make sure it actually does behave as we'd expect. and then it has to pass through Graham compliance. So, this is a cross-departmental effort. Handbooks, procedures, audits, cross-checks, and double checks are all part of what we do here, and we really benefited from the length of time we've been doing it. These procedures have been built up over years, and before we make any changes in our production world, it has to go through that entire testing cycle. So certainly we think of the experience here as providing significant advantage to our process.
Great. So, sitting here today, performance has been strong, which is good. We've just heard about the exciting research that the team are working on. Clearly, we have a robust process that means we can all sleep at night. I'm tremendously proud of what this group have been able to accomplish, and they should be congratulated for it. However, it would be very easy to become complacent at times like this, and we must not let that happen. We need to recognize that what has led to us being successful up till now, it may not be enough to keep us successful into the future. So we always have to try and improve every single aspect of what we do, the models, the process, and so forth. Sort of with that in mind, looking ahead to the future, Tom, based on your experience and expertise, sort of what do you think the future outlook is like for systematic macro?
Yeah, we see a lot of good opportunities. This is a macro regime with many significant drivers. So we expect, for example, market prices to make bigger and extended directional moves to seek out new equilibrium levels. This should benefit models that do systematic trading, identifying trends in prices as well as macro fundamentals. Also, looking at different countries, we think that they are likely to adopt very different monetary and fiscal policies. And this increased dispersion will benefit relative value trading style. And the systematic strategies that process a lot of data are best poised to take advantage of this added dispersion. In particular, I think that our Graham quantitative macro strategy should benefit and have lots of good opportunities because it has multiple components that are designed to work specifically for under different types of market environments. Looking back to prior to year 2020, we saw that the macro fundamental and carry components worked the best. In the tough market conditions of the last 2 years, the trend and value pieces kicked in and saved the day. But we're happy to see that so far this year, all 4 components have adapted to the dynamic situation that we are seeing, and they are all delivering very strong positive returns. Besides having strong signals, we are also happy that we have a strong risk management process. We have the risk overlay that looks at market volatility and changing correlations. And this year, after having made strong returns in first quarter, the risk overlay was able to cut our exposure in the positions by reacting to the higher volatilities and correlations, and thereby preserving a lot of the trading profits as prices then started to fluctuate or have reversals.
We'd be remiss without talking about fixed income, right? And as we've already mentioned, fixed income no longer appears to be the good old reliable portfolio diversifier it once was. And for us, that's not such a big deal. You said we have sophisticated portfolio construction. We run these broad and diverse portfolios. We've kind of been able to avoid these problems, not wishing to sound smug, but how should other people think about this problem?
Sure. I want to first point out that one single asset class is not sufficient. That said, I think it's possible to find viable alternatives for fixed income. Our recommendation is to have a combination of safe haven assets, what we call structural tail protection products, and then active alpha strategies. So these structural tail protection are like buying put options and the VIX futures. The pros is that they deliver very precisely measurable diversification benefits, and they can work well in case of a market crisis. Of course, the cons is that they are expensive to trade and hold. This is where the active alpha strategies kick in. They can provide long-term returns that offset this cost and then do more. They can provide extra bit of market diversification when certain market price events happen as well to complement the structural tail protection. But it takes skill to put together this portfolio and manage it well. You need to precisely identify how much protection you need and how much return you can potentially deliver. And you need to also be prepared to dynamically change the allocation weights. Otherwise, you are not going to capture either the protection that you need or the long-term returns that you are aiming for. So all considered, we recommend that investors should look at a portion of their portfolio that up to now are passively managed by just buying fixed income. And then instead, they should approach a more dynamic approach. It should be quantitative, and it should be holistic, and most importantly, it should be rigorous.
Great. Like I think Tom highlights an important property of systematic strategies, and that is that they are inherently flexible and we can customize them. I've learned that what is optimal in one person's portfolio probably isn't optimal in another. There's no one-size-fits-all solution. And if I look at where people have used systematic strategies successfully, it's often been where they've had a very clear understanding of what it is they are trying to achieve. I can then take that definition, I can look in the toolbox that we have, the capabilities, the strategies, the models we have at our disposal, and can combine them in a way that hopefully delivers the type of returns that an investor wants to see. And that can be pretty varied. Some people want tail protection. Some people, as Tom described, they want an alternative to fixed income. Some people just want to try and make money every day. And I feel no matter what it is, we have the appropriate building blocks. I just want to make sure that we can combine them in a way that is optimal for the people that are ultimately using them. And Tom, one more question for you, then I'll stop, I promise. We're going to have to be very brief on this, looking at the time. Inflation, it's a hot topic. How do our systems respond to it?
I think we can make good money in inflationary environment. For example, commodities respond very well to inflation, and we can trade global financial assets as well by going long short or creating relative value positions. Now, there is a valid concern that in historical data, we have not had many episodes with high inflation. But we counter that by broadening the scope of our data. Outside of the normal CPI and PPI, we incorporate wages, we incorporate import-export prices, implied break-even levels, and economist surveys, and now we can do news text as well. So these together will give us a very up-to-date picture of inflation on a kind of daily time scale, and allows us to generate very dynamic signals that allows us to take advantage of this high inflationary period and still do well.
Great, thank you. And I'll give you a rest now. Andrew, back to you. How do you think about the opportunity set for what you do?
Yes, well, opportunity set in our view for systematic equities is phenomenal. We mentioned that easy money in simple strategies is gone, right? And we mentioned also other challenges and trends that we see in the markets. But the flip side of all of that is really a very rich opportunities for sophisticated investors. And there are three main things that I would highlight as defining that, right? One is dispersion. We're at higher improved volatility levels. What this means is it means higher premium for ability to generate real alpha and real edge, right? Well, important to know that it will, to capture that premium, will require strong, systematic, and very robust and adaptive risk management. We see ourselves as very well positioned here, right? Another thing is complexity. The world is more connected than ever. We need to capture and model this growing ecosystem of interconnected companies, industries, products, sectors, and even individuals. And given the breadth of tradable universe and multitude of linkages, this complexity is especially pronounced in single name equity space, right? We believe that our approach is able to take advantage of this complexity. We embrace it, essentially, we model it, and we treat it as really a source of alpha. And third thing is data. We all see growth in volume of information that is being available, right? It's a trend that is obvious to everybody, but also we see growth in types of information that is available. And this growth in data allows us to continue to pursue breadth in information dimension, to deliver even more edge and capacity in our strategies. So dispersion, complexity, and data growth, we clearly see outline of a very rich opportunity set for systematic equities here. And the systematic approach, as we practice it, is uniquely equipped to take advantage of it and thrive.
That's great, thank you. And now, looking at the time, I really need to start wrapping things up. But I just want to say something about timing. Like, we've just heard Tom and Andrew talk about what they, expect to be a very promising opportunity set for what we do. But look, undeniably, we're coming off a very good run of performance. If you're an existing investor, hopefully you're pleased at the returns we've been able to generate. If you're a prospective investor, maybe this is giving you pause for concern. And I get it. Nobody wants to buy the high. We think about this problem a lot ourselves. We make allocation decisions all the time. We've got a tremendous body of research associated to this problem. We've made some of this research available on our website, but I'll save everybody the bother of reading it. We have not found an ability to time our own investment strategies. Good periods are not necessarily followed by other good periods or by bad periods. In fact, the last 6 or 12 months turns out to be a pretty poor predictor of what one should expect to see over the next 6 or the next 12. And all of that is relevant because I think sitting here today, in my memory at least, that there hasn't been a more important time to consider the merits of a systematic strategy. With a very logical, rules-based, rigorous application, they can help bring order to uncertain times like the one we're in right now. We can build portfolios that are free from bias and human emotion. We build portfolios that can go long and can go short. Therefore, they make money in both rising and falling markets. We build portfolios that are diverse and broad. They are not dependent on a single opportunity or a certain market regime in order to be successful. We build portfolios that don't look like other things that people already have exposure to. And at a time when simple, passive investment strategies, 60-40, risk premia, Andrew gave the example of equity style factors, at a time when they've been underperforming, and our expectation is that in all likelihood, they will continue to underperform given the new market regime that we're in. There hasn't been a more opportune time to instead consider a sophisticated, dynamic, well-risk managed systematic exposure within portfolios. It can produce the type of alternative return that, as we've seen this year, can be very, very valuable. So now I really will wrap up. I'll say thank you to the audience. Thank you to my fellow panelists. You guys have done a fantastic job. My understanding is there is the opportunity to submit questions and feedback. So I guess as long as it's nice, we look forward to hearing it, and we'll do what we can to answer as many questions as possible. So with that, thank you once again. Take care. Have a good day.